We learned in the previous section as to how people qualify for various loans as well as how that's determined. In this section, we'll do an even deeper dive into loan origination and underwriting. In order for an underwriter to determine if an applicant is a good candidate to approve for a loan, they look at a borrower's net worth, which is determined by subtracting their liabilities from an applicant's assets. Remember, an applicant's liabilities include their financial obligations or debts. Assets are the items of value that an applicant has, such as stocks, insurance, checking, savings accounts, etc. Applicants will have to sign IRS Form 4506T for the underwriter to access their tax returns. A borrower's payment history on previous mortgages or rent must be verified for 12 months. Ultimately, an underwriter is responsible for assessing an individual's risk, and this can be done manually or with an automatic underwriting system like we've talked about before. Underwriters are especially concerned with an applicant's adequate reserves. These are typically 2 months' worth of principal, interest, taxes, and insurance after the down payment and closing costs have been paid. For investment properties, however, 6 months' worth of principal, interest, taxes, and insurance must be verified on loans that are non-owner occupied. Remember, it's important that you understand that consumer debts must have more than 10 payments remaining to be included and counted as debt. Lease payments on automobiles, however, must also be considered as debt obligations regardless of how many payments are left. Any type of income that an applicant includes on their application that has commission, overtime, bonuses, part-time, or interest or dividend income will need to be averaged out and shown to be consistent over the last 2 years to be considered as income. If an individual claims to be self-employed, that means that they must own 25% or more of a business and have 2 years of personal and business income tax returns. Retirement income, pension income, and the receipt of child support or alimony, however, must continue for 3 years minimum in order to be included as income. As we stated before when we talked about the federal law known as ECOA, alimony, child support, etc. does not have to be used if the borrower does not want to include it. But if the borrower does want to include it, the lender cannot refuse to consider it as income. If an applicant is receiving rental income, an underwriter will only consider 75% of the amount accrued as income. The other 25% is seen as what's known as a vacancy factor. Any income that comes from public assistance is non-taxable income and is grossed up by 1.25% during underwriting. If an applicant works seasonally, unemployment income may be considered as part of qualifying income. If unemployment is part of an applicant's work cycle, then it must be shown as being consistent on the tax returns from the past 2 years. When we talk about LTV, better known as loan to value, we are referring to the loan amount divided by the lowest value of the home, whether that be the appraisal value or the purchase price. That LTV percentage is what is used to determine when PMI is canceled on loans and for various other purposes. The combined loan-to-value ratios include the first mortgage plus the second mortgage divided by the lower value of the property, whether it's the appraised or purchase value. A high loan-to-value, or HLTV, is the first loan amount plus the maximum available balance on a home equity line of credit divided by the lesser of the property value or purchase price. The housing expense ratio, or front-end ratio, is the principal, interest, taxes, and insurance divided by the gross monthly income. The total debt to income ratio is the principal, interest, taxes, and insurance plus monthly debt and obligations divided by the gross monthly income. Remember, a borrower's first monthly payment after loan consummation is usually due on the first day of the second month after closing. So if a loan closed on October 11th, then the first monthly payment would be due on December 1st. Oftentimes, when a borrower finds a property they want to purchase, they may not have the most ideal interest rate based on the market at the time, as well as various other factors may contribute to that as well. The two types of documents associated with the loans are the mortgage and the promissory note. A par interest rate is the break-even point for a lender. So if a borrower wants an interest rate lower than par, then the borrower can reduce the interest rate by purchasing points, also known as buy-downs. Points are used to lower interest rates by 0.25% or 0.25%. The price of each discount point costs 1% of the loan amount. There are also origination points, where 1 point equals 1% of the loan amount. The interest rates that a borrower receives have the ability to either be float or locked in. If a borrower receives a rate lock, it is the lender who promises to hold an interest rate or a number of discount points for a specific period of time. The loan originator collects all of the information and sends the package to an underwriter. The work the loan originator did on the loan is paid to them through origination fees, which covers the administrative costs to close and service the loan. So let's do an example together. The Sims family is buying a house for $350,000. After their 15% down payment, they have decided to pay 2 discount points. What is the dollar amount of the discount points? Well, since the Sims family put 15% down, their loan amount would no longer be $350,000. It would be $350,000 multiplied by 0.15, which equals $52,500. We then would subtract $52,500 from $350,000, giving the Sims family a loan amount of $297,500. Now that we have the loan amount, we can now find the discount point cost. Well, we know that 1 point equals 1% of the loan amount. So 1% of $297,500 would be $2,975. So $2,975 would be the cost of 1 discount point. However, in this question, the Sims family purchased 2 discount points. So we would multiply $2,975 by 2, and the total would now be $5,950. So the cost of the 2 discount points for the Sims family that they would be purchasing would be $5,950. Any discount points purchased by the borrower are paid upfront to the lender, and the origination points are paid to the loan originator as a fee for their service. Yield spread premium, otherwise known as lender credits, is a tool that mortgage loan originators can use to reduce a borrower's settlement costs. Here are a few more math ratios you need to be sure you familiarize yourself with. The annual interest rate equals the loan amount multiplied by the interest rate. The monthly interest rate equals the loan amount multiplied by the interest rate divided by 12. The daily interest rate equals the loan amount multiplied by the interest rate divided by 365. If you are given the annual income but need to find the gross monthly income, you would take the annual income divided by 12. If you are given the bi-monthly rate but need to find the gross monthly income, you would take the bi-monthly rate multiplied by 24 weeks divided by 12. If you are given the bi-weekly rate but need to find the gross monthly income, you would take the bi-weekly rate multiplied by 26 weeks divided by 12. If you're given the hourly rate and weekly hours worked and need to find the gross monthly income, you would take the hourly rate multiplied by the weekly hours worked multiplied by 52 divided by 12. Remember, bi-weekly means every other week. So since there are 52 weeks in a year, you divide 52 by 2 and you get 26. Bi-monthly is a term that means twice a month. So regardless of how many weeks are in that month, it will occur twice a month. So there is 12 months in a year, and people on a bi-monthly pay schedule get paid twice a month. So 12 multiplied by 2 equals 24. Be sure you understand the difference between bi-monthly and bi-weekly. If a friend or family member gives a lump sum gift to be used for a down payment, an accompanying gift letter may be required which states that the amount is not expected to be repaid. Remember, the lender always makes the final decision to fund a loan. The lender is also the one who issues the clear to close. You need to remember that the maximum allowable contributions by sellers on investment properties are 2% of the lesser of the appraised value or sales price. For a principal residence or second home with a loan to value greater than 90%, a seller or lender may contribute 3% of the lesser appraised value or sales price. For a principal residence or second home with a loan to value between 76% and 90%, a seller or lender may contribute up to 6% of the lesser appraised value or sales price. And lastly, for a principal residence or second home with an LTV, loan to value, of 75% or less, a seller or lender may contribute up to 9% of the lesser appraised value or sales price.